Today we cover the 5 key reasons you need to consider investing in commodities, which could be delivering some of the best returns in global markets with AI demand taking off. I'm Jessica Amir, a market strategist here with Moomoo, and welcome to the Weekly Moo. It's great to have your company as always. So commodities look set to roar in 2026. And when I say commodities, some might be thinking, sure, that's a very broad category, Jessica, but today's focus is specifically on base metals and precious metals. So we're going to look at the 5 reasons that you need to consider investing in this broad sector because it could be delivering some of the best returns in global markets if demand for artificial intelligence takes off like we expect. So let's think about Nvidia, Google, Amazon, Broadcom, and Meta. They're all doing very exciting things, and perhaps you could argue changing the world as we know it. They're producing some of the strongest investment returns in equities as well. But I would argue, regardless of who wins the AI race or who is leading in revenue and earnings growth over the next 5 or 10 years, then you should be thinking about commodities because commodities seem to be winning and they probably will win either way. So, why is that? Well, it's because these companies that we're speaking about, they're continuing to demand commodities to build out the global artificial intelligence ecosystem. And this is precisely why commodities have delivered the strongest returns year to date across all global markets. For example, silver, it's up 102% this year. Gold's up 61%. Copper's up 27% year to date. Now, these commodities are outperforming the key indices in the US, such as the S&P 500 and the NASDAQ. They're up 16 and 18% respectively. So that's something to consider. But most investors have finally turned into the artificial intelligence sector. They're totally outlooking or overlooking the role of commodities and why it's so pivotal to this sector. And I guess that needs to be really brought to cusp because we do know that we could be on the cusp of a major multi-year bull market that could be kicking off and beginning right now in commodities. We do know that a momentum is building up around the idea of commodities, especially silver. It may be entering blue sky territory in 2026. And markets could push even higher. Yet again, if markets are comfortable with a couple key inflation reads that are due out before next week's Federal Reserve interest rate meeting. And if the data comes out like the market expects, and if central bankers can cut interest rates and the Fed does that, then you'd think that commodities could ignite further gains. So let's explore those 5 key factors that are creating powerful tailwinds for commodities and precisely why you should be considering investing in them. So, first off, number 1 reason to consider investing in commodities is because December is a great month for commodities. We've spoken about this before here at Moomoo, but historically, December is one of the strongest months for both the Aussie and US market liquidity because, it's say that again, it's traditionally one of the strongest months for Aussie and US markets because liquidity thins and sentiment improves. But it's also the second best month of the year for gold and silver. Silver, throughout history, has risen 2.7% on average. That's looking back at the last 10 years. And gold has rallied 2.2% on average in December, again looking back over the past 10 years. Now, these December seasonal gains give strength to commodities that statistically have pushed higher into year end. Reason number 2 to consider investing in commodities is that big institutions typically rotate into investments in December that are looking like they're going to, I guess, front run returns in the year ahead. So institutions are basically buying into stocks with strong forward earnings. They're basically buying into stocks and sectors that are likely to do well and are positioned for growth in the year ahead. So in this argument, we need to consider that investor fear, as measured by the volatility index or tracked by the VIX, that's fallen from its November high. So you could also think about this argument that markets have found a potential floor forming under equities and commodities as well. And now we've got this other layer, institutional money. Institutional money is flowing back into the sectors that have got perhaps the clearest line of sight or upside up and to the right. So commodities are at the top of that list, and that should be on your radar as the third or as the second reason to consider commodities. Reason number three to consider investing in commodities is the US dollar. The US dollar has continued to fall. It's around 3-year lows, and this provides a major uplift tailwind for metals and energy commodities. That's because they are priced, obviously, in the peg currency, the US dollar. Now, basically, consider this a softer US dollar. It's historically been a key driver for higher commodity cycles. And again, going back to that argument, what if we do see central banks cut interest rates? Well, that will further pressure down the US dollar. And you guessed it, that'll likely push up commodity prices as well. Again, because commodity prices are in US dollars. Reason number four to consider investing in commodities is because demand for commodities is outstripping supply. This is the biggest catalyst of them all. The world is undersupplied in metals and energy metals as well, while demand keeps accelerating. Let's think about the demand for aluminium, you might say aluminum, also the demand for lithium, copper, gold, as well as other essential metals. They're all rising sharply, driven by a couple of key things: AI infrastructure, the build out for that, rapid EV adoption, expanding solar capacity, and also consider we're seeing rising defense spending. Now, all of this supports the case that the supply demand mismatch is the strongest you could argue in over a decade. And this could supercharge returns for commodities into 2026. Reason number five to consider investing in commodities is because commodities, particularly gold, usually outperform when we see other markets not doing so well. They basically act as a hedge and outperform in periods of inflation, and also when we see the US dollar depreciating, like we're seeing, also when we're seeing geopolitical tension rise. And right now, we've got all these dynamics occurring. Let's think about in Australia, for example, we've got inflation rising faster than expected. And this reinforces the appeal of real assets acting as, I guess, a market stalwart. And let's also think about gold as well. It deserves an honorable mention because it actually tends to do well when equity markets are under pressure. But over the longer term, the gold price has actually outperformed the Australian markets ASX 200. And this is a trend that I've highlighted repeatedly throughout my research. And this makes gold one of very few assets that's consistently delivered downside protection and also long-term returns relative to the Aussie share market. And basically, all of this, these five reasons, basically form the backbone for why commodity prices should remain elevated, and these trends will continue likely into 2026. And also, we're saying why we believe, or why I believe, investors will be increasing their allocation to gold, energy, and other metals as they position their portfolios for what could do well. So, the next question you might be asking is, hang on a minute, how should I be investing in commodities? Well, let's bring in perhaps some of the largest and most liquid commodity ETFs globally. This could be a really good starting point for you if you're looking for diversified exposure across metals and resources. So let's just kick off with some of the biggest now in the world. Two global major ETFs are standing out. We've got the Invesco DB Commodity Index Tracking Fund, DBC, and the iShares S&P GSCI Commodity-Indexed Trust. So DBC, for an example, that's one of the largest diversified commodity ETFs in the world across energy, metals, and agriculture, while the other one that I mentioned, GSG, that tracks the world's biggest commodity index, and it's heavily weighted towards energy and industrial metals. So these could be strong options for broad market exposure for commodities. But if you're interested in the precious Metals, let's talk about silver. The silver iShares Trust ETF, SLV, and you've got the Spider Gold Shares ETF, GLD. These are, well, they should be top on your radar because they're the most liquid and widely used vehicles for gold and silver. SLV, for example, it's the world's largest silver ETF. It's basically backing, you know, the higher silver prices. It's very liquid and it offers straight up direct exposure to silver. While GLD, I've spoken about that a lot. That is the world's largest gold ETF. And again, it's physically tracking the gold price. And it also provides, I guess you could argue, efficient access to the spot gold price without the need for you holding it. That's a consideration. These two ETFs also keep silver and gold in vaults at some of the exchanges in the world. For more research on those, you can just type their tickers into Moomoo's platform and you'll find more information. But bringing back in mining exposure ETFs, if you do want exposure to mining companies, that is, there's two ETFs that stand out. One of those we've mentioned a lot, the Global X Copper Miners ETF, a COPX. This gives you diversified copper exposure specifically to miners, and miners benefiting from the rise in electrification, the rise of the green energy transition. The other one is the Global X Silver Miners ETF, again, offering exposure to silver producers. And this basically, you could say, is a leveraged play to the silver price. One that I've also been speaking about a lot is GDX. This is the VanEck Global Miners ETF. This is the world's largest gold miners ETF, offering exposure to the biggest gold miners in the world. And these are actually outperforming the gold price. And this is because they're generating strong cash flows and they have profits and they're able to return their profits to shareholders. And that also supports higher share prices as well. The takeaway from this, well, while the world is fixated on tech companies, we speak about them a lot at Moomoo, commodities are already delivering some of the strongest investment returns in the market, and the setup remains very strong for 2026. And perhaps we could see 2026 be one of the most favorable years of them all for commodities that we've seen in over a decade. That's, of course, thanks to demand accelerating for AI and, of course, a softer US dollar. So commodities deserve far more attention from investors, and maybe they deserve your attention too. Thanks for your company.